Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Fed cuts 50. So if you've watched any financial news recently, you are all too aware of the choice the Fed had this past week to lower their Fed funds interest rate target by either 25 or 50 basis points. They obviously chose the latter. Now, if you're not familiar with the term basis points, each point represents 1/100th of a percentage point. So 50 basis points is 1/2 of 1%. At first, stocks weren't quite sure what to make of the news. Could it mean the Fed was actually worried about the economy or maybe knows something that the rest of us don't? So after an initial spike higher, stocks actually finished the day lower on Wednesday after the Fed's announcement. That weakness didn't last long though, however. By Thursday morning, a major rally was underway with gains of more than 2% on the S&P 500 index and 3% on the tech-heavy NASDAQ. The Fed believes they can start lowering rates because inflation has slowed down over the past year. They better be careful, however. Markets are suggesting that too much Fed easing will allow inflationary pressures to reaccelerate quickly. That's evidenced by the recent moves in gold and other inflation-sensitive commodities like oil. Gold prices are up 13% in the last 3 months, and oil prices have jumped more than 10% in just the last week. Let's hope the Fed knows what they're doing. For this week's featured insight, Interest Rate Dynamics Explained. Be careful what you wish for. As many people have been clamoring for the Fed to lower rates, they may not have considered that lowering short-term rates doesn't necessarily cause longer-term rates to fall. The Fed controls overnight lending, the shortest of short-term rates. Longer-term rates like mortgages are a function of market forces, the supply and demand of loanable funds. Since the Fed's announcement this past week, longer-term rates have actually moved higher. Now, why did that happen? Well, because investors anticipate the potential for reaccelerating inflation, as I previously explained. Long-term rates are also evidence that there's a cost to allowing borrowing and printing and spending that the federal government is doing. You might think it's a free lunch today, but you'll pay for it tomorrow in the form of inflation. Looking ahead, a most dangerous stretch. Investors might be partying like it's 1999 after this past week, but they would be wise to check the calendar and realize the next few weeks could be a bit treacherous. The second half of September and the first half of October averages out as the most difficult part of the year for stocks. Now, does this mean stocks always fall during this stretch of time? Of course not. However, with the Fed now in the rearview mirror, markets may focus more on election uncertainty, and more volatility is certainly not out of the question. Stick to your long-term investment plan, but don't get carried away by taking excessive risk chasing stocks higher just because the Fed seems primed to give the markets what they think they want. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.